Hello, everyone. Thank you very much for joining us once again today and welcome back. I believe I'm audible. Let me check one more time. Yeah, I think everything is fine. Thank you very much for joining us once again today and welcome back. We are discussing today history and tools of Pillar 2. In our previous lecture, whatever we have discussed, we have conducted so many webinars on the corporate tax, and this is one more. Our last four webinars specifically, it was on the deferred tax assets, deferred tax liabilities, and exploring the mysteries of deferred tax in the UE means treatment of deferred tax, specifically keeping in view the requirement of the UAE corporate tax law. We have already discussed, I believe the last session that we very insightful session specifically dealing with the requirement of the deferred tax, keeping in view the transitional provision, keeping with the post-transitional provisions. We have discussed all these things in our previous webinars. So whatever we are discussing today, as I discussed, this is session specific. This is pillar 2. We'll look into the evolution, we'll look into the history of Pillar 2, and after going through the history of Pillar 2, then we'll discuss what are the tools available for the Pillar 2, what Pillar 2 wanted to, what the basically the authorities, international authorities, local authorities, what they wanted to achieve through the Pillar 2. So far as the history of Pillar 2 is concerned, the history of the Pillar 2, just it was started. I just wanted to give the background for this. The history was started in 1948. Initially, one organization was set up with the name of European Organization for European Economic Cooperation in 1948 after the World War II, and the main purpose of this organization was the recovery program of the Europeans. Then in 1960, one more organization was set up with the name of Organization for Economic Cooperation and Development. This organization replaced the OEEC, Organization for European Economic Cooperation. What was the objective of the OECD? Objective of the OECD was to promote the economic growth and to create the cooperation among the countries just for the welfare and growth of the people of the economy. This was the core objective to set the Organization for Economic Cooperation and Development. Once the OECD was set up, these are the number of countries. Then they started joining OECD, Austria, then Belgium. Overall, there are total, I think 37 countries are there, 36, 30, 38 countries. These countries are the members of the OECD. These are the member countries of the OECD. I have taken this number from the website of the OECD. This show there are 39, 38 members of the OECD. The first member in 1961, because the OECD was set up in December 1960. And the first country that joined, the initial countries, Austria, Belgium, Canada, all these countries joined in 1960. You can see Italy, Spain. The last country that they have joined is the Costa Rica, Colombia. All these countries they have joined in the latest, the very new member. You can say they have joined in after 20 or 21, in 20 or 21. Total 38, 39 member countries. So what was then? Once this OECD was set up in 1960, definitely they will be doing a lot of other things as well. The most important thing related to the topic that they have done, what they did, first of all, they started working on the basically multinational company. They are shifting the profit from the high tax jurisdiction to the low tax jurisdiction. Once the multinational companies are moving the profit from the high tax jurisdiction to the low tax jurisdiction, then this is at the end, this is the tax revenue loss. This is a tax revenue loss. This is the and then loss to the authorities as well, because the companies are earning the revenues, companies are making the profit, but they are not paying the tax on it because they are moving the profit from the high tax jurisdiction to the low tax jurisdiction. So they use the term base erosion and profit shifting. This is called BEPS. Base erosion and profit shifting, as I mentioned, the multinational, they increasing the base, basically they're moving the profit from the high tax jurisdiction to the low tax jurisdiction. Base erosion planning strategies to reduce the multinational enterprise profit in one country, which is a higher tax base. Higher basically reduces tax base. These, wherever they are, that where in which country, in which territory, in which jurisdiction, they have the lower tax rate, they are increasing the base there, and wherever they are the high tax, they are reducing the tax base there. Basically, from suppose there's a tax in UK tax is around 20%. It was initially it was 19%. I think they've increased right now. Okay, initially 19%. UK tax is 19%. UE tax is 9%. If one company is shifting the profit from UK to UAE, then it will be considered base erosion and profit shifting, because the higher tax in UK, lower tax in UAE. So what they are doing, they eroding the base from the UK. They are building up the base in UAE where the taxes are low because they wanted to avoid the taxes. This is the concept of base erosion and profit shifting. And OECD observed in 2013, there was a tax revenue loss around 100 billion to 240 billion dollars on annual basis. What was the loss? Loss was 100 billion to 240 billion dollar loss on annual basis. And to cut this loss, they introduced the BEPS. They taken the initiative in BEPS, the initiative of BEPS. And OECD has taken this initiative on BEPS in 2012, 2013. Look into this example. This is a classical example I mentioned for the base erosion and profit shifting. How they are eroding the base, how they are shifting the profit. Just look into this, that high tax interest rates are high tax interest rate loan are being granted to the company which is based in high tax jurisdiction to the lower taxable profit in the high tax jurisdiction. High tax loans are being granted to a company which is based in, suppose a UAE company is giving loans to the UK company at a rate which is very higher than the market, so that when the UK company is taking the loan and giving interest, that interest will become income of the UAE company, expense of the UK company. Once it become expense of the UK company, income of the UAE company, here cost is being increased to erode the profits, and their revenue is being increased in UAE to build up the base. Their revenue being increased because tax base will increase in UAE. Their cost is being increased because tax base will be reduced in UAE. So in UK, the companies will be liable to pay lesser tax, and they will be liable to more tax basically in UK they will be liable to pay lesser tax, and because the cost has gone up, and they will be taking the benefit. Just look into this example. This is the country A, country B. Country A is in low tax jurisdiction like UAE, and country B the high tax jurisdiction like UK. Assume just for discussion purposes. So here the GP 100,000 OPEX. This is the basically area where everything at an arm length basis. This is profit is 340,000. This is profit is 450,000 after tax profit. Now they have structured one loan. Once they have structured one loan, I discussed UA company might be giving loan to the UK company at a higher tax rate. If the company is giving higher interest rate, if the UAE company is giving loan to the UK company at the higher interest rate, now they have given a loan at 10%. This is 3 million loan. 3 million loan has been given from the low tax jurisdiction company to the high tax jurisdiction company. So it will become interest cost. It has become their interest cost. It has become their interest income. So once they have given a loan at 10%, their taxable profit before interest in high tax jurisdiction is 200,000, which was initially 500,000. Due to this loan profit, sorry, this is 200,000. Yeah, 200,000. Due to this one transaction, the tax base in UK has been reduced. And initially, the company paying a tax of 150,000. Just due to this tax, the company is paying tax only 60,000. So the differential is basically reduction in tax. Now, if this rate 10% in the arm length basis might be this interest would have been come, for sure it would have been come. If the interest would have been come, ultimately taxable profit would have been bit higher, whatever is given in this example. So what this company did, the company has moved their profit from the high tax jurisdiction to the low tax jurisdiction. Once the company has moved the profit from the high tax jurisdiction to the low tax jurisdiction, this is called BEPS, base Orion. They eroded the base from UK and they built up the base in base Orion and profit shifting. So to control this tax revenue loss, OECD brought the OECD take an initiative. So OECD was set up in 1948. Sorry, OECD was set up in 1948. OECD was set up in 1960. OECD has taken initiative on BEPS in 2012, and OECD has introduced BEPS action points in 2000. OECD has introduced the BEPS action points in 2013. These are the 15 action points. These are the 15 action points on BEPS. These 15 action points on BEPS, these are 1, 2, 3, all these are given. And whatever we are discussing, I think this will fall under transfer pricing. So these will be 6 to 8 to 10. These are the 15 action points. These was 15 action points were introduced by the OECD just to control the profit shifting and base Orion to control the base Orion. Objective was basically from where the multinationals are generating the profit, they need to pay tax in the same jurisdiction, and they should not erode the profit and from the high tax jurisdiction to the low tax jurisdiction. After this, these are the basically 15 action points. After this, if you will go into this history, first of all, the OECD was set up in 1960. After this was an organization for economic cooperation for the European, then OECD was set up. OECD taken initiative on the BEPS project. I told you the reason. What is the reason that the OECD has taken initiative on the BEPS project? Because the tax revenue loss around $240 million, $1 billion annually, the OECD decided to control it. Then in 2015, OECD officially launched the 15 BEPS action points. I've already told you these are the 15 action points that were launched by the OECD. In 2016, OECD launched the inclusive framework. Now, as I told you, there are only 38 member countries, 37, 38 member countries of the OECD. But this framework is in need of cooperation from the all countries across the globe so that the OECD will be able to control the base Orion and profit shifting movement of revenue from the high tax jurisdiction to the low tax jurisdiction. Since the OECD wanted to control it, so OECD was in need of the support of the global community. To gain the support of the global community, OECD set up framework on BEPS. And this framework on BEPS was set up in 2018, and there were around 135 countries who had joined this framework on BEPS in 2018. Or even UAE has joined this framework on BEPS in 2018 as well. So objective was basically to control this loss of revenue. OECD then started public consultation paper in 2019. This was their own public consultation paper. In the consultation paper, they have recommended that we need to apply the minimum tax of 15% globally. So once the multinational, they are earning an income and a revenue beyond some certain threshold, then they need to pay certain tax on it as well. So sorry. So in the public consultation paper, OECD given a recommendation of 15% minimum tax, and in 2020 OECD launched Pillar 1 and Pillar 2. They have launched this Pillar 1 and Pillar 2, and this minimum 15% tax was approved by them in 2021 by the G20 countries. Based upon this 15% minimum tax, the OECD launched Pillar 1 and Pillar 2. Now, what is Pillar 1 and Pillar 2? Pillar 1 is basically, this was specifically designed for the companies which are in providing the digital services like Facebook, like LinkedIn, like Insta. So many other companies which are making revenue, they have offices somewhere in Ireland or any other country of the world, then they are generating revenue across the globe. Now, The companies are located in one jurisdiction, but they are making revenue across the globe. The principally, the companies from where they are generating the revenue, they need to pay the tax in the respective jurisdiction as well. So they have decided, okay, this was the core objective, basically segregation of revenue based upon the origin of the revenue. If the revenue is being generated from India, tax should be applicable, tax revenue should go to the Indian government. In the same way, if the revenue is being generated from Pakistan, Africa, Australia, from wherever it is being generated, revenue principally needs to go to the respective jurisdiction, which was basically allocation of the revenue based upon the user, where the users of the services are located, revenue should go there. But there was some sort of bottlenecks, some sort of pitfalls. What are the bottlenecks? What were the pitfalls? Allocation of revenue, one of the biggest challenge. How to allocate the revenue? Second biggest, there were this is only revenue. There will be expenses as well. Expenses are being stationed at one point. Revenue is from the multiple locations. They need to bifurcate the expenses to the respective jurisdiction as well. Moreover, they need a coordination at the international level from the all authorities across the globe. They need of coordination to implement pillar one. Second thing, for the digital company, this is fine. What about the manufacturing company where they have a machinery at one point? Then they can plan, they can structure how to trace basically from where the manufacturing company and digital company are making the revenue. So these were the basically pitfalls, difficulties for the pillar one. So OECD has decided to launch the pillar two as well along with the pillar one. And pillar two, they said every multinational company which is earning a revenue 750 million euros in any 2 years in the previous 4 years, they need to pay minimum 15% tax on their overall profit. This is the summary of pillar two. So UAE, as I mentioned, UAE had already signed the inclusive framework. So UAE was supposed to implement the pillar two as well. And this is the reason that the UAE issued the public consultation paper on the pillar two. So if you are going into this is the same thing what we discussed basically. This was the OEECZ, then it was OECD, then loss of revenue, then a BEPS project, then 15 BEPS action points. In 2018, you also joined the inclusive framework on the BEPS. Then OECD public consultation paper, pillar one, pillar two, 15% tax rate, and you will issue the public consultation paper on BEPS as well. Okay. Now, why pillar two in UAE? I have already told you the reason. What is the reason for this? And the reason is basically UAE is also a member of the BEPS inclusive framework. So UAE was supposed to implement the pillar two as well. So if the UAE is not implementing, what were the basically difficulties, uneven playing field, risk of tax and base, basically risk of BEPS is there as well, pressure of competition, because UAE is also part of the global community. So there will be some sort of goodwill impairment, constraint in the international relationship. Moreover, as you know, the all big powers, international powers, they can ask, okay, they can ask for some sort of penalties and sanctions, as you know. So all, I mean, it's not only for the matter for the UAE, this is of the global community. Whoever is not joining the pillar two or the inclusive framework, then might be they will not be able to enjoy the reputational loss as well, risk of penalty, as I mentioned, risk of sanctions as well. There are constraints in the international relationship. So this was the reason due to this BEPS was introduced. So this BEPS was introduced and this pillar two was introduced. This was the reason that the pillar two was introduced, and why pillar two is in the market. I've already told you the reason as well. Now the UAE has issued a public consultation paper. This is a digital public consultation paper which has been issued by the UAE in March 2024. So this consultation paper have two sections. This is a questionnaire, then a guidance paper as well. Here's the link. You can click on the link. You can go to the public consultation paper. You can give your feedback. You can give your opinion on this. The consultation paper is open on April 10, 2024. You need to give your feedback, and based upon your feedback, based upon the feedback of the respective stakeholders, the UAE government will design their Pillar 2 policy. So this is the evolution and this is the history of Pillar 2. As we discussed, it started from 1960. Objective was to control the BEPS. They brought sport, they've taken a sport of the OECD, they've taken a sport of the G20 countries, they've adopted multiple series of action just to control the BEPS, Pillar 1, Pillar 2, 15% tax, sport of the global community. Now the global community is launching Pillar 2 to make sure that the multinational cannot basically erode the base in the high tax jurisdiction, shift the profit to the low tax jurisdiction. Now the question is how Pillar 2 works. This is another important question. How Pillar 2 works. Pillar 2, this is the basic requirement as I mentioned. I already told you the multinational company, if their revenue in any 2 years out of the last 4 years is more than 750 million, 50 million euros, then they need to apply Pillar 2. And for this Pillar 2, once they are applying Pillar 2, they will be liable to pay minimum 15% on their overall income. So this Pillar 2 has four tools. This Pillar 2 has four tools. The first is QMDTT. This stands for Qualified Domestic Top-Up Tax. Second one is subject to tax rules. Third one is income inclusion rule. And fourth one is under tax payment rules. These two called GLOBE, GLOBE. This is basically anti-baseline. This is called subject to tax rule. This is treaty-based rule. This is the basically qualified domestic top-up tax, and we will look into this each area. If you the process will start from here, QMDT. Then this is SRTT. This is the number 2. Then IAR at number 3 and UTPR number 4. In this tool, in QMDT, at the global level, an option has been given to the respective jurisdiction, respective country, that if they are going to implement any local taxes which are in line with the guidance issued by the OECD, then whatever is the total tax, basically they need to pay 15% tax, and whatever the 15% tax, they need to deduct the whatever the tax that they have collected, they have applied locally based upon the guidance issued by the OECD. This is the reason this is called qualified domestic top-up tax. But it will become qualified only once this taxation locally has been implemented based on the guidance, based on the rules, in the light of the guidance issued by the OECD. Now the second comes, this is the subject to tax rules. These subject to tax rules are, this is a treaty-based rule. They said basically, suppose this is one company in UAE, and this company is giving any services to KSA. Assuming, just for discussion purposes, if in the UAE the tax rate is less than 9%, corporate tax is less than 9%, then they said the KSA company has the right to withhold the tax, and whatever the tax is being held by the KSA company, this fall under the subject to tax rules, and this will be considered whenever overall 15% has been calculated. Out of this 15%, these two taxes will be removed. QMDT, qualified domestic top-up tax, along with this subject to tax. Then after that, then we need to apply income inclusion rule, IIR. Income inclusion rule is basically, we'll look into this in example as well. This is the one company in suppose in USA company, and this company is paying certain amount of tax 25%, but the one company in Africa, that company is paying tax on 10%. So what the law says, basically OECD tool says the income of the African company needs to be included in the income of the USA company, and the USA parent company needs to pay tax to the USA government. This is basically, again, if the USA company is not didn't want to apply the IIR, the any other company in the chain, they need to apply the IIR. Objective is to make sure 15% tax is going to the government. Now, in case in certain situation, if we cannot apply IIR, then the fourth is basically under tax payment rules. This under tax payment rules will be applicable based upon the tax applied by the IIR. If IIR is applying 0% tax, you under the UTPR is under tax payment rule, we need to apply 15%. And if 5% tax has been applied here, we need to apply here 10%. If 10% tax has been applied here, we need to apply here 5%. So this is the reason these two called basically interlocking rules, interlocking tools. Whatever the UTPR is being applied, it depends upon the IIR. So this is called interlocking rules. This is called preference treatment that under the tax. This is called subject to tax rules. Just look into this. So qualified domestic top-up tax. This grants the relevant territory to retain taxing rights in the respect of the low tax profits rather than the relevant profit being taxed in the parent entity. This is, as I told you, if the local entity, suppose UE or any other entity who is part of the BEPS inclusive framework, they are collecting tax locally, but they are collecting this tax under the guidance issued by the OECD. In the light of the guidance issued by the OECD, there are no chances of BEPS profit shifting here and there. Then the whatever the local taxes that is being collected by the local jurisdiction, then they will be able to deduct this tax while adjusting 15%. We'll look into the examples. Now, the subject to tax rule, as I said, basically for the subject to tax rule, if the country that is providing the services is generating the revenue and that country is generating income, and that income is not subject to tax in its own jurisdiction, then the country where these services are being provided, that country has right to hold the tax. We'll look into this example as well. This is the reason that this is called a priority rule. Why this is called a priority rule? Because this rules falls before IRR and this rules falls before UTPR. So this is the reason this is called a priority rule. Income inclusion, and it follows the top-down approach. Why this is follow the top-down approach? Assuming this is the company A, this is the parent company, then there is a company B, this is a subsidiary, then there is a company C, this is another subsidiary, then there is a one company. Assuming this company is paying tax 30%, A is paying tax 30%, though here is the one company D that is paying tax 10%. So first of all, law says, first of all, A will apply tax, pay tax to its authority, the differential tax. Principally, as we discussed, the minimum tax rate is 15% as per the Pillar 2 rules. So here this is paying 10%. We need to pay extra 5%. Once we need to pay extra 5%, principally, first of all, the OECD rule says the parent company needs to pay. If the parent company is not applying IIR, income inclusion rule, then the next entity in the chain, this entity needs to apply the IIR. If this entity is not applying, this entity, wherever jurisdiction they are, they need to apply and they need to pay remaining differential amount to the respective jurisdiction. This is the call that this approach is called top-down rule. The next is under tax payment rules. This under tax payment rule, this is the backstop rule. It all depends if we are not able to collect 15% by applying IIR in income inclusion rules, then we need to apply the under tax payment rules. Once we are applying the under tax payment rules, we need to make sure that on overall basis, 15% is being paid to the tax authorities. So these are the 4 rules. This is just a high-level discussion regarding the rules. We will have a very comprehensive sessions in the future, how to calculate the income, how to follow the processes, and how to go through all these things. Now the agreed rule order. This rule order I have already told you. First of all, we need to apply the QMDTT qualified domestic top-up tax. Then we need to apply the subject to tax rule. Then we need to apply the IIR, and then we need to apply the UTPR. This is the side that I taken from the OECD presentation. They said, first of all, we need to apply this, then we need to apply this, then we need to apply the multiple IIR, the UTPR. They have not given subject to tax rule because these are the treaty-based rules. And if 9% is not applicable in the country who is providing the services, then subject to tax rule will be applicable. Otherwise, it will not be applicable. Now, once we apply these tools, there are four tools, and we discuss we need to apply all tools to make sure 15% tax is being collected from the multinationals or whoever is the entity, and this 15% tax is being paid to the respective tax authorities. To collect the 15% tax and to apply these four tools, OECD has given step-by-step process. What is this step-by-step process? They have given, first of all, determine whether the MNE group is within the scope. First of all, we need to assess, is this applicable, is this pillar 2 is applicable on the group or not? This is the first question. And the criteria is basically 750 million euros in any 2 years out of the 4 years. Might be there are some excluded entities we need to remove it. For the excluded entities like investment houses, we need to exclude a certain criteria for this we'll discuss. So once these entities are being removed, remaining entities, so law says on the excluded activities, tools will not be applicable, but their revenue will be considered to assess the threshold of 750 million euros is breached or not. This is very important. And second important thing is 2 years out of the 4 year, we need to assess. Then we need to decide pillar 2 will be applicable or not. Second thing is income allocation. First, we need to identify, assuming this is a group A. This group A has entities here globally, 1, 2, 3, 4. For each entity, we need to assess basically, okay, first of all, we need to assess the revenue. Why we need to exclude the excluded activities. Then we need to assess the income of each entity. And this income will be based upon the financials. Based upon the financial, we need to assess the income. And after assessing the income, okay, now we know the entity. This is the entity. These entities are subject to, these entities are subject to pillar 2. We know the entities. We need to assess the financial income of those entities based upon the financials. We know the income. Then we need to assess what is the tax that they have paid. So once we have the income, once we know the entities, once we know their income, once we know their taxes, now we have three things. First, we have the entities which are subject to constituent entities. We know the entities, we know the income, we know the expenses. Then the law says you need to apply, you need to calculate the effective tax rate. What will be effective tax rate? Total tax, basically total globe income. You will get one effective tax rate. Basically, this effective tax rate will be the tax rate what is on overall basis this group is paying to the tax authorities. So total tax divided by total globe income, it will become effective tax. And this effective tax, we need to compare this with the 15%. If the effective tax is coming 10% and the loss is minimum, we need to pay 15%, 5% is the differential amount, and multinational needs to pay 5% extra to the authorities. So this is the process. First of all, determine whether the MNE group is within the scope. This is the first. Second, allocate the income. Assess the income of the respective entity and overall income. Then calculate the globe income. Calculate the income of the each entity. Then calculate the tax of each entity. Determine the adjusted cover tax. Then calculate the tax of each entity. Then you need to apply this formula to calculate the effective tax rate. Effective tax rate, as I mentioned, it will be total taxes. Effective tax rate, it will be total taxes divided by globe income, multiply 100, you will get the effective tax rate. Then you need to compare this effective tax rate with the 15%. If this is less than 15%, you need to apply and collect further taxes. If this is more than 15%, then this is. And to collect the differential taxes, you have the tools. And these tools are domestic top-up tax, qualified domestic top-up tax. Then the second tool is the STTR, subject to tax rule, IIR and UTPR. You have these four tools to collect the differential amount of tax. So this is a 6-stage process as given by the OECD in their guidelines. Just look into this example. We are just going to close after going to discuss 3-4 examples. A taxpayer has taxable income of 100 arising in a jurisdiction with a 10% effective tax rate. Now, effective tax rate they have already given. Effective tax rate they have already given. We know what should be the tax, 15%. How much is the effective tax rate? We are not going to calculate. They have already given it. This effective tax rate, given effective tax rate is 10%. 5% is the differential. 5% we need to pay. So 15% less 10%, 100 we need to pay. But this 20, I think I have not discussed. This is again another important thing. Sorry. So now, substance-based income exclusion, we need to deduct this income because this income has real substance in the respective jurisdiction. So we need to deduct this to while applying 15% tax. This we will discuss again in our coming lectures. So if you are going to do the solution, this 10 is the effective tax rate. Minimum tax rate is 15%. 5 is the differential they need to calculate. SBC, substance-based income is 2500 minus 2570. So 75 into 5%, 3.75% further tax this group needs to collect and pay to the tax authorities. And we know what are the tools to collect this tax. The non-qualifying income, if assuming this 25 is not there, substance-based income is not there, then this 5% differential amount will be applicable on 100, then result will be 5. They need to collect 5 and give it to the government. Look into this second example. This is the application of IIR. This is the jurisdiction C, this is the jurisdiction B, this is a B, this is a C. The parent company, C Limited, this company is applying IIR. Now, this is the B, and this is the jurisdiction A, this is the jurisdiction B, this is the jurisdiction C. Let me just look at this example. So we discuss identify the entities, 6-stage process, identify the entities, identify their income, identify their taxes, calculate the effective tax rate. This is their taxes, this is their income, this is the effective tax rate of the respective entity, this is the overall tax rate, this is the overall tax rate, effective tax rate, this is the effective tax rate of the respective jurisdiction. So it means once we are doing this, we are completing the 3-stage process. Now we need to compare this effective 4-stage process. Out of the 4-stage process, 4 steps has been completed here. Now 9% is my effective tax rate. Minimum tax applicable is 15. 9 minus 15, 6%. 6% is the extra tax we need to collect and give it to the respective authority. Since this domestic company C is applying IIR, C collect from here, and from here, and this will pay to the tax authorities in their country. So income is how much? Income is 1200. 1200 into 6%, 72, 84, 78, total 234. A will collect, parent company will collect and parent company will give it to the tax authority in their country. Look into this, one more example. This is similar, something like this. Covered, these are the taxes, these are the states, these are the ETR, this is the minimum tax, this is a differential tax, 7%. This company is into the losses, so this company is not liable to pay 15% of their income. Their loss will be distributed in the respective while doing the calculations. Loss has been apportioned in between A and A2. Remaining amount is 1154. This less losses 1154, then we need to apply 7%, and we need to collect extra 175. We need to give it to the respective tax authority. This is IIR approach, income inclusion approach, 6-stage process. First we need to identify the entities, then we need to calculate their income, then we need to calculate their taxes, then we effective income, effective tax, then we need to calculate effective tax rate, then we need to calculate the differential, then we need to apply the tools, and we have applied IIR tool to collect the tax and give it to the respective tax authority. Look into this one more example. This income is this is dealing with the IIR and UTPR under tax payment rules and income inclusion rules. A parent company has 2 subsidiaries, FinCo and OpCo. This example I have taken from the OECD guidelines. The parent company has office in a jurisdiction where tax rate is 20%. Finco and OpCo's jurisdiction has tax rate of 5% and 25%. Hey, the issue. Because this company is paying 20%, this company is paying 25%, this company is paying 5%. As per the income inclusion rule, parent company, if the parent company is applying IIR, the parent company needs to include their income in their income, and they need to calculate the differential amount of tax, and they need to pay to the tax authorities in their jurisdiction. So Finco has given a loan to OpCo, this company has given loan to OpCo, and this they are charging interest income 100. Loan has been given Finco to the OpCo, and Finco is charging interest, and the value of the interest is 100. OpCo EBIT is 200, Finco has 0. Earning before income tax. Earning here, earning is 200. Here earning is 0. Except this interest. Now, this company is paying 5% tax. So what A needs to do? A needs to apply IAR. I need to collect. So first of all, we need to calculate the effective tax rate. What is the effective tax rate here? 5 divided by 100, 5%. Differential is 10%. So effective tax rate is 5%, minimum tax is 15%, differential top-up tax is 10%. The top-up tax that needs to apply 100 into 10. 100 is the income, 100 into 10, 10. This company needs to pay 10 to the respective authority. Now, assuming one of the major condition is that this company in the respective jurisdiction, this company is applying IIRR. If this company is not applying IIR, I have already told you, once we are not applying IIR, then UTPR will become active. And if 15% has been collected through the IIR, then we are not liable to apply the UTPR. First, we need to apply IIR. We have applied IIR. 15% has been collected over. If this company is not applying IIR, this company cannot collect the differential from B. Then we need to go for the UTPR. UTPR, there are two models for the UTPR. Two techniques to collect the tax through the UTPR. These two techniques are, first technique is denial of deductions. Denial of deductions. So whatever this 100, this is being paid to B, tax authorities will ask, see, don't deduct it from your profits. Don't deduct it from your profits. Once this C is not deducting 100 from their taxable profit, C's tax base will go up. Once their tax base will go up, then C will be liable to pay more tax. And at the end, they will collect 15%. This is the first thing. So denial of deduction. This is the first technique in the UTPR, denial of deduction. Or you can do this. Second is withholding tax. There are two possibilities. You can apply A or B. There is no sequence for this. You can go for withholding tax. You can go for denial of deduction. So the first is authorities will ask, okay, don't deduct this 16% out of that while calculating your taxable profits here in C and pay the tax on behalf of the B. First, second option is that A needs to withhold the tax on B's income and A needs to pay tax to the, C needs to OpCo. OpCo needs to withhold the tax while making payment to the Finco, and OpCo needs to pay this tax to the respective tax authority. So what should be the value of the tax? They need to gross it up to make sure minimum 15% is being paid to the tax authority. So just look into this. OpCo will apply tax 10 divided by 25%, 40. So 100 is the interest, 40 is their payment they are making, total is 140, 25% of 140 is basically 140, 20, then 25% will be OpCo own tax. On this 140, if you are taking a split of this basically, this 140 is, and out of this 140, 25% of the tax will be OpCo own tax and remaining 10 will be Finco tax. So this amount will be withheld while making payment. So we'll look again, as I discussed, once we will discuss all these techniques in more detail, we'll look into this, all these things. But initially at the upfront, I'll say while applying UTPR under tax payment rules, there are two options. Either there are denial of deductions. This is the first thing. Second thing is withholding tax to make sure 15% is being paid to the tax authorities. Now in this jurisdiction, then one more scenario has been added. Then now two more entities are there. This applying IIR, this applying IIR, this applying not any IIR. Top-down approach. Entity A, jurisdiction A. Jurisdiction A is not applying IIR, so they cannot collect tax. So IIR B and this is entity D and E. D and E both are applying IIR and both can collect. Both are, they are holding 40% in B where the tax rate is 5% in FinCo. This entity is holding 60% in FinCo where the tax rate is 5%. So they need to collect in proportion. The same thing will be applicable like this differential 5, 10%, 10 they need to collect this 10, 40 over 10, 100, it will be collected by 40 over 100, it will be collected by sub-parent 1, 60 will be collected by sub-parent 2, because both are applying IRR, this entity will pay 4 to the tax authorities and this entity will pay 6 to the tax authorities. On overall basis, 15% tax will be applicable on this group, which is subject to pillar 2. This is the last example. This is typically for the subject to tax rules. So we discussed already two rules. One rule IIR we have discussed, UTPR we have discussed. Domestic, qualified domestic top-up tax, this is very straightforward thing. If this is being applied in the guidelines of the OECD, then they will be considered deduction. Now the fourth rule is basically subject to tax rules. Subject to tax rule, I have already told you, this subject to tax rule, it is called priority rule as well, and it will fall before IRR, it will fall before UTPR. And UTPR and IRR, these are the interlocking rules basically. UTPR depends upon the IIR. And UTPR will be applied after the IIR. Just look into this example. This is example number 4. Company A, this is a CICO 1 is in country C, which has been taxed of 25%. CICO is in country C, which has a tax rate of 25%. Country C exempts 80% of the royalty income. So where this CICO is in country C, and if CICO is earning any income in country C, any royalty income in country C, that royalty income, 80% of the income will be exempt. If they are earning 100, then out of the 100, so 80%, okay, effective tax rate is 25%, 80% is exempt. 25 into 8 to this will be the effective rate for the royalty income. So company CICO earns royalty income of 100 from BICO. Okay, this is the jurisdiction. Just look into this. This is CICO. This is C assuming. This is country C. In the country C, this is the CICO. Okay, this is assuming B. This is the company B. CICO is earning income from B. Income is 100. This is the royalty income. And in CICO, the tax rate applicable on the royalty is 20. Overall corporate tax is 25%. Overall corporate tax is 25%. But the tax rate for the royalty is 25% into 80%. It will be equal to 4%. Yeah, it will be equal to 4%. So in jurisdiction C, the corporate income tax is 25%, but the corporate tax for the royalty is 4%. Means if C is earning CICO, if CICO is earning any income of royalty out of any jurisdiction other than C, then B, whenever making payment to C, B has a right to apply the subject to tax rule because 9% tax is not applicable here on royalty income. So as we discussed in the beginning, the country which is providing the services, if the 9% tax is not applicable in the respect. So basically you can say effective tax rate for the subject to tax rule is 9%. And if this 9% is not applicable in the jurisdiction which is earning the income, then this needs to be topped up as well. And this will be deducted while calculating the overall 15% tax. So while making payment to C of 100, they will apply 5% further tax, because effective tax rate for the STTR subject to tax rule is 9%. So 4% will be applicable in jurisdiction C. 5% it will be applied by B. Overall effective tax rate for the STTR is 9%. Right? Now they are asking, this SICO is earning any other income from any other jurisdiction, assuming this is a jurisdiction D. They are earning 100 from this jurisdiction as well. So how much is the total income of SICO? SICO total income is 200. How much the tax SICO has paid? SICO will pay tax 9 plus 25. 25% of 100. 9 plus 24%, 25% of 100, it should be 34. No, SICO, just look into this. FTR reality is 5%. Reality, this is effective tax rate, is effective tax rate for the STT is 9% and the reality is 5%. Minimum tax STTR 9%. SICO will apply this 5%, 4%. Top of tax is 5%. Top of tax is 4%. So 25 into 80, 25% into 80, it should be 5%, not 4. So 25% of 80. 25% of 80, 80 into 0.25, it should be. Tax is 25 into 80, 25% into 80. So 25% into 80%. 80% of 25%. ETR and reality in country C is 5%. Okay. And effective tax rate for the reality is 9%. 9%, 4%. Differential is 4%. 4% total 9%. Okay, that is fine. Then how I calculated this 5%? 25% of 40%. Effective tax rate. Okay, effective 25% of 80. 25% of 80 is 20. 20 divided by total income of the reality is 100 into 5. Yes. Into 5. This is 5%. So this is actual tax rate. How this 5% is coming? Royalty income which is subject to tax, this is effective, this is 80% into 25%, 5% is basically 5%. So royalty, how much royalty they are earning? 100. Out of the 100, 25% is subject to 8 to 25. 20 is the basically 20 divided by 100, 5%. So royalty tax is 5%. Effective tax is 9%. Extra they need to collect 4%. Effective rate overall 9. Now look into this. Now it means out of the 15%, whenever they are applying 15%, out of this 15%, extra tax they have already collected, which is 4 point, this is total 9% has already been collected. So global income is how much? Global income is overall of C 200, 100 from the royalty and 100 from the royalty and 100 from the other party, 200. How much the tax they are paying? Tax they are paying 4 plus 5. Total tax they have paid 9. 9 divided by 200. Total tax is 4.5%. Effective tax rate is 15. 15 minus 4.5, 10.5%. So 10.5% they need to pay extra tax. 200 into 10.5, 25. The total tax will be 25 plus 9, 30. 30 will be the total tax, and this 30 overall will be 30 divided by 200, which will be equal to 15%. So what I'm trying to highlight here, you can look into this example. This priority rule subject to tax rule has been applied before IIR. So you can see here, so 4 plus 5, total how much? 9 divided by 200, 4.5%. And while applying the effective tax rate, this 4.5% has been deducted because this 4.5% has already been collected through the STTR rules, subject to tax rules. Thank you very much. Thank you very much for being with me. So we'll keep discussing this in the next three, four webinars. We'll try our best to make sure that you are understanding this concept very thoroughly. What a pillar two, as we discussed today, that how to apply the IIR, how to apply the UTPR, how to apply the subject to tax rule, how to calculate the qualified domestic top-up tax. Then what is the reason for this? What is the history? Why it has been applied? Now, if you are going through the public consultation papers, you will be able to understand the public consultation paper very easily and very thoroughly. So if you have any question, you are most welcome. Do you have any question? Okay, guys, thank you very much. Thank you and have a lovely evening. Thank you very much. Thank you for being with us. If you have any question, you can contact us at info@chriscooper.com. You can drop us an email as well, info@chriscooper.com, and you can give us a call as well at 97433914888. I'm always there. My team is always there. We are always happy to help you. Thank you very much and have a lovely evening. Thank you. Bye-bye.